The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Matt Miller.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. Let's get a check on these markets, shall we? The S&P 500, it's a little bit lower, but we've broadly shaken off that hot PPI print that we got this morning. The S&P 500 was a little bit higher earlier. Now it's a little bit lower too when you take a look at the NASDAQ 100 and your big tech names there, off by about 0.1%. All the pain today is in the small caps. The Russell 2000 down 1.4% after that PPI reading this morning. A big reason why is because take a look at the bond market. 10-year yields higher by about 6 basis points right now, knocking on the door of 4.3%. And it's a similar story at the short end, too, because traders really thinking about what actually does the Fed do next month, Matt?
Yeah, absolutely. We have had, though, a record-setting run in stocks. It's taking a little bit of a breather, as you showed today, after fresh inflation data came in hot, lifting bond yields and the dollar. You can see here behind me, PPI month over month. You're going to want to look at ex-food and energy, and especially the year-over-year figure of the core PPI. U.S. producer prices rose in July by the most in 3 years, suggesting companies are passing along higher import costs related to tariffs. Corporate America now faces a hurdle as the spreads between wholesale and consumer prices shrinks, and that may dig into margins. Even with core PPI at 3.7%. Futures are still showing a 93% chance for a Fed rate cut in September or thereabouts. Yesterday, we were talking about 2 cuts after U.S. Treasury Secretary Scott Bessent said there's a very good chance of a 50 basis point rate cut. But Bessent walked that back this morning, saying that he isn't calling for rate cuts from the Fed, just pointing out that, quote, any model would suggest a neutral rate would be at least 150 basis points lower. And this morning, Bloomberg opinion columnist John Authers pointed out that that suggests a neutral rate that is lower than the current core CPI, a number that could climb if today's PPI is any indication.
Absent us falling into a significant recession, the Fed doesn't really need to cut.
And while PPI might show that companies are passing along tariff costs, they're still hurting the top and bottom lines. This earnings season, Deere flagging tariffs on steel and aluminum ate into profits. Coach, parent Tapestry, incurred an extra $160 million in costs from tariffs in the current fiscal year. And Advanced Auto mentioned it is working with its vendor partners to manage tariff-related cost increases.
So we have a lot to dig into there, and we're going to do that. I wanted to take a look at mid caps because we talked about the large caps in the S&P 500. We talked about the small caps in the Russell 2000. Mid caps don't get a lot of attention, and maybe you can understand why when you take a look at their performance. You have the mid cap index in orange here, the S&P 500 in white, and you can see since the lows of April, we've had the large caps really take control and charge ahead. The mid caps, they are positive on the year, but not by much. And you think about where this goes. It's been the large caps that have been driving this market for years at this point, Matt. But we have at least one guest, and he's coming up just in a minute now, who says that heading into the 2026 midterms, it could be this orange line that gets really interesting. Yeah, in fact, let's kick things off right now with Jimmy Chang, Chief Investment Officer with Rockefeller Global Family Office. Jimmy, thanks so much for coming on set, joining us on The Close. You and I were talking about this before the program, that you could see the president, this administration, start to run the economy hot into the next election, mid-cycle election season, I should say, and that could boost the economy and inflation. Is that good for mid-caps?
Yes, it's very economically sensitive. I think if you look at the sequencing of events, the OBBB's benefit to households will really kick in the spring of next year, probably $120 billion of fiscal stimulus in terms of tax refunds. Investment spending will also get 100% expensing. That's going to be helpful to the economy. But between now and then, there's a risk that higher tariffs will pressure the economy. So the Senate is already working on a potential $600 per person so-called tariff rebate checks, which is reminiscent of the helicopter money in 2020. So imagine if Congress gets to send these free checks to every household, a family of 4 gets $2,400. The Fed starts to cut interest rates, and then you get the OBBB benefit kicking in the spring of next year. That could be potentially very stimulative by early next year, leading into the midterms.
And we've had so far real concentration. Obviously, it's been the biggest of the big tech stocks that have led earnings growth as well as the stock market. You see that shifting down a little bit?
Right, because if you do get stronger growth, then the participation will broaden out. You will see medium-sized companies and even quality small-cap companies starting to play catch-up. In fact, since the election last year, small-cap and mid-cap are pretty much flattish, while large-cap, especially tech, have done so much better. And in fact, most of the earnings growth here in the second quarter, I would say 80% of the earnings growth come from the top 8 companies. And that includes Tesla dropping about 50% in terms of growth versus a year ago. So that portion has just been leading the market, and they're less economically sensitive. They're benefiting from the AI investment cycle. But if there's sufficient stimulus being pushed into the economy, small cap and mid cap should play catch up.
So should play catch up. Are you calling them to outperform, though, some of those large caps? Would you go that far with this call?
I actually think they could potentially outperform in such an environment. Of course, the caveat is going to be interest rates. Because if you have the Fed cutting interest rate, bringing rates down at the short term, but on the other hand, with inflation potentially moving higher, growth getting stronger, you could see inflation reaccelerating. And in that case, it can probably pressure valuations of those companies that have very high valuations. So in that respect, given that small cap, mid cap are still relatively cheaper, I actually think they could outperform.
I do want to talk about the difference between small and mid caps. A lot of people mention them in the same breath. So the specifics of your call are that the mid caps definitely quality small caps too would do well in that environment. If that's the case, you do have this when you do have this rising tide, why wouldn't it lift the entire small cap sector? Why limit it to just quality that might do well there?
You're right. If you get into a more speculative market, the lower quality names tend to even outperform more. But from an investment standpoint, rather than a trading standpoint, 40% of Russell 2000 companies are not yet profitable. Some of them are fairly low quality. So as a long-term investor, I'd rather stick with the quality small cap and the mid cap space, which are still relatively cheaper than mega cap and have good balance sheet, good cash flow, whereas the lower tranche of the Russell 2000, they are more speculative. They could potentially outperform for a period of time, but as a long-term investor, I would stay away from it.
I want to get back to this Besant authors conundrum here, where the Treasury Secretary says any model shows that the neutral rate should be essentially below where core CPI is, even as core CPI looks to be on the rise. There's a tension here, right, between the Fed's two mandates. Inflation may come, but the labor market also may be weakening. So which one do you think wins out?
That's a challenge in this unusual stagflationary environment. It comes down to which do you overweigh. Is it the employment mandate or CPI, PPI? Now we will get another set of data before the September FOMC meeting. I would assume if we get a very weak reading in employment, if we get a contraction, for example, that will probably cement the 25 basis point, and there will be call for a 50 basis point cut. In terms of inflation, the argument for rate cuts would be that it's a one-time event, right? Because it's due to tariffs, which would be over a year from now in terms of the comparison. But that said, we're actually seeing higher inflationary pressure on the services side in today's PPI report. So that's a new challenge because it's not tariff-induced. It is possibly due to a tighter immigration market fueling lower end wage pressure.
Jimmy, awesome to have you in here. We have to get you to come on the morning show with us, right?
It's called Open Interest.
You can come on Open Interest between 9 and 11. We'll get your take then as well. Jimmy Chang is the Chief Investment Officer with Rockefeller Global Family Office. Coming up, from producer costs to consumer costs, we'll sit down with David Tinsley, Senior Economist at the Bank America Institute, to discuss his concerns about the U.S. consumer, even with debit and credit spending rising to its highest, or maybe because of debit spending rising to its highest growth rate since January.
Plus, a conversation on the broader American economy and if a 150 basis point cut from the Fed is even feasible with Ken Rogoff. He is professor of economics at Harvard University and former chief economist at the IMF.
Of course, those cuts would be divided over like a year's worth of meetings, so it's not like at once. We're going to look at how policies out of the White House are impacting all of this with Libby Cantrill, managing director and head of public policy at Pimco. We see the curve flattening today. All that and more coming up. This is The Close on Bloomberg.
While consumers are spending more and maintaining their financial health despite tariff-related price pressures starting to creep into economic data. That is according to Bank of America Institute's latest consumer checkpoint survey. Let's bring in the man behind the data. His name is David Tinsley. He is senior economist over at Bank of America Institute. David, great to have you with us. And this is what everyone is watching for, right? When does the consumer start to get exhausted and say, actually, no, I can't handle anymore? It seems like it hasn't happened yet, according to this latest check.
Yeah, well, when we look at our data, and here what we're doing is we're looking at the 69 million Bank of America's spending, often on their credit and debit cards. And when we look at that, there was a period of weakness, a wobble, if you like, in April, May. But actually, I think the really reassuring thing in this data, our data right now, is we've seen 2 consecutive months of increase now, and actually 0.6 on the month in July. So that's a good increase. And in the detail, one of the things we were a little bit concerned about a few months ago was that consumers seem to be pulling back from discretionary purchases, particularly on travel, so airlines, lodging, that kind of thing. Actually, in the latest data, that's picked up as well. So I think, you know, obviously we have to be cautious, but the consumer is hanging in there, you know, in pretty reasonable shape right now.
It's actually amazing to me, David. We're going to talk to the CEO of Malibu Boats in the next hour. They make, you know, performance, high-end, like wakeboarding towboats. And their sales for the Malibu and Axis brands rose 70% in the March quarter. Shocking to me because, you know, I want to buy a boat, but interest rates are too high for me to take that kind of loan. How are consumers in America able to do this kind of spending?
Well, you know, that's a really interesting point, because what we're seeing in our data is a distinction, quite a sharp distinction and a divergence between lower income consumers, where their growth is 0 over the last year in the latest data, and higher income consumers, which are growing at about 1.8%. So obviously the yacht owning community is right at the end of that, but nonetheless there is this distinction opening up in the data between lower income households and the rest.
And I would love to hear your thoughts on where we are in terms of businesses passing on higher costs, because we got CPI, we got PPI, and it seems like they were telling 2 different stories. You didn't see CPI tick up in a big way, but the PPI this morning suggests that actually we are seeing some of those costs being passed through. What does your data suggest on the topic?
Well, at the top line, our data is sort of consistent with the consumer price data. We did see transactions in retail space increase a little bit less than the dollars spent. So in other words, there was a bit of a price uplift, but only worth like 1/10 of a percent. Now, our small business data, which we also look at, shows small business profitability also in pretty reasonable shape, still increasing year on year. So I think what we've seen in those 2 prints over the last couple of days is a margin squeeze, of course. You know, CPI not increasing too much, wholesale prices increasing more. That's squeezing somebody's margins. So I think we have to keep looking for it. Perhaps it will come, but right now our data is kind of consistent with this story that pass-through to the final consumer is limited right now.
David, we were talking with Jimmy Chang just before the break about the Fed's dual mandate and, the tension right now. If we start to see inflation pick up and we see this, we've already seen the jobs market weaken pretty considerably. Which way does the Fed go? Do they prefer to fight inflation and stop that in its tracks, or do they prefer to support the labor market?
Yeah, well, we're not forecasters at the Institute, thankfully, but our economists in B of A Global Research are forecasting no change currently in the Fed policy throughout this year. So, their view really is that things like the consumer spending data still have a reasonable legs in them. Maybe the consumer's even picking up again a little bit. At the same time, core CPI, quite sticky still. So our house view, if you like, is that the Fed will remain on hold.
All right, David, great to get some time with you. Really appreciate you joining us here on The Close. David Tinsley there is a senior economist at the Bank of America Institute. Coming up, Tapestry tanks after tariff costs and weakness at its Kate Spade brand sent shares south. We'll discuss with an analyst who covers the name next. This is The Close on Bloomberg. Time now for our top calls. A look at some of the big movers on the back of analyst recommendations, starting with Steel Dynamics. Wells Fargo reinstating their coverage of the steel company with a recommendation of an overweight and a price target of $143. The firm also reinstating coverage of similar firms, saying that if tariffs stick, it would be good for the pricing and profitability of domestic steel manufacturers.
Up next, CVS, Baird upgrading the healthcare and retail pharmacy services company to outperform from neutral and setting a price target of $82. The analyst has, quote, growing confidence in the company's turnaround story. Shares up about 1.3%.
And finally, Hanes Brands, Wells Fargo raising their weighting on the underwear company to equal weight from underweight and modestly increasing their price target to $6 from $5. The upgrade follows HBI's strong quarterly results, along with the news that Gildan has agreed to buy the company for $2.2 billion. Hanes Brands today down about 1/3% near the close. Those are some of our top calls for the day.
Let's stay in the clothing and retail space because we're also watching shares of Tapestry plunging after the company reported that tariff costs are weighing on its profit outlook. Here to discuss, I'm pleased to say we have Alex Straton, Equity Research Managing Director over at Morgan Stanley. Alex, great to have you with us. I'm taking a look at your reaction. You write that there's no change here to your overall bullish thesis on the company. Clearly, investors have a different take this afternoon. We're in the afternoon now.
Certainly. But yeah, the stock is down quite a bit. But, when I look at the fourth quarter report, the initial full year guidance as a whole, I think it really reflects more of the same narrative that's actually driven this bullish sentiment over the last 12 months. And that's namely coach momentum, enabling sales and gross margin driven upside and ongoing operating margin expansion beyond what many of us thought would have been the case. And so for us, when we think about the overweight rating, the bullish view, it's been predicated on a few things that are still intact on the back of the print, which is a positive revision path ahead for the next 12 months. We do still have attractive tariff positioning, though some of that surprised to the downside today that we can talk about. And then finally, what I describe as ongoing secular tailwinds in the handbag industry broadly. So we're still remaining positive. There were some blemishes against a expectation for perfection today, but otherwise, same narrative to me.
Alex, I'm curious. I'm not a mall snob, but once a consumer has moved from a Kate Spade or a Coach or what have you up to like a Gucci or a Louis Vuitton, they're all in the same mall, but you still probably feel a little bit snooty, right? Can you go back down to that brand like Kate Spade or Coach from those more expensive brands when you need to tighten your belt?
Sure. I think it's an interesting question. And what we've seen, at least in our survey work across consumers, is that there's an increasing diversification of the handbag industry. So what does that mean? Market share is fragmenting. So whereas once it was more concentrated, people are willing to buy more in diversified types of handbags. So to me, I think particularly in an environment where a consumer is pressured, or there's perhaps, price elasticity dynamics happening in the luxury sector, there's definitely an opportunity for trade down. I mean, when you think about something like where Coach's price point's at, let's give an example, the Kisslock bag, it sits at about $700. That's, a third to less of the luxury entry price point at this point. And so I think as you think about a potentially pressured macro, there's certainly some room for trade down, and we see broader diversification and within the handbag industry and consumer preferences.
Let's talk a little bit about some of their specific brands. Coach and Kate Spade. Romaine Bostic, who normally anchors this program, spoke with the CEO of Tapestry, and she told Romaine that we've been working to build momentum in Coach over the past 5 years. And with Kate Spade, we're learning a lot from Coach. And Alex, I would love to hear your perspective on whether some of the things that they are learning from Coach can map over to Kate Spade and try to help turn that brand around.
Sure. So the Coach story is super unique. We rarely see brand turnarounds be successful in this space. So it's definitely a bright spot for the total business. And effectively how they did that was they cut the tail on SKUs, so think less product. They stopped discounting as much, and then they targeted a younger consumer, which is going to drive the majority of discretionary spending go forward. So there's a lot in common when you hear some of those themes with things like, Abercrombie or Gap or Ralph. There's a lot of, turnaround similarities. So I think what we see at Kate right now is some of what we saw early days at Coach. You see gross margin starting to improve as you sort of clear out those discounting-oriented customers. But there's also a revenue drag as you do that, right? Because you're clearing out a certain customer before you're necessarily recruiting a new one. And at the same time, you're investing from an SG&A perspective. So what does that all round up to? It rounds up to profitability pressure that'll continue for Kate. But to me, it's a very similar trajectory to what we saw for Coach. You first see the signs of gross margin improvement, even though total profitability might still be pressured. And that's effectively exactly what they guided to this year, but perhaps wasn't totally appreciated by the street from a strategic perspective heading into the print.
All right, Alex, great to get your perspective on one of the big movers of the day. That is Alex Straton. She is Equity Research Managing Director over at Morgan Stanley. I will just quickly point out that even with today's decline, Tapestry shares still higher by 49% year to date. Just what an incredible run. Now coming up, we're going to speak to Ken Rogoff. He is Professor of Economics at Harvard University and the former Chief Economist over at the IMF. Don't want to miss that one. This is The Close.
It is just about 3:30. Actually, it is exactly 3:30 p.m. in New York. This is the Countdown to the Close. I'm Matt Miller.
And I'm Katie Greifeld. And U.S. Treasury Secretary Scott Bessent says he's not calling for a series of rate cuts for the Fed. He does think that rates should be 150 to 175 basis points lower, though. Yeah,
I think he was just clarifying some of the comments he made yesterday in his interview on Bloomberg Surveillance with John Farrow and Anne-Marie Hordern, where he said essentially he expects basically 50 basis points of cuts in September, and that the neutral rate should be, as you say, 150 to 175 basis points lower. That isn't actually so far out there if you look at pricing on WIRP, right? Because the market expects that too by the end of 2026. It's just that we have now a situation where inflation looks like it's higher than 3% and climbing.
Exactly, and that PPI figure that we got this morning at 8:30, maybe before 8:30 this morning, you could argue for a 50 basis point cut, and maybe there were some people out there that expected that. Now that looks a little bit more difficult when you think about where producer prices are. And
it's all made more confusing by the tariff policy, right? And the volatility of that. Let's talk about it with Ken Rogoff. He's a professor of economics at Harvard University, former chief economist at the IMF. Professor, great to have you on the program. One of the things markets love, and I'm sure to some extent economists as well when doing research, is a little bit of certainty in public policy. And that's something we just don't have right now. So how difficult is it for you and your colleagues to understand the effects that the tariffs the president wants to put on not only imported foreign goods, but also now exported goods, what effect they're going to have on inflation?
Well, it's really hard to tell until the smoke clears. For example, on the tariffs, he'll say one thing one day, another thing another day. I mean, how do you make predictions when it's such a moving target? I think in general, the economists will prove correct that most of the tariffs will be paid by consumers. It will mostly pass through to prices. I think what nobody really knows is it's so unusual. What are going to be the second round effects? What else is going on in the economy? If you have some inflation coming from tariffs on an otherwise slowing economy, probably won't notice it that much, but we don't quite know where we are. I mean, certainly the labor market revisions were pretty stunning and makes it clear the economy's not on quite as strong, nearly as strong ground as people thought.
Your 2009 book, This Time Is Different, the title was funny because that's something you're not supposed to say, right? But this really is different in terms of the uncertainty of tariff policy and the attack on Fed independence. I don't know if the word attack is too strong, but certainly it's in question. How does that especially change the picture?
Well, I think it paints a picture of a lot of volatility over the long term. I mean, Donald Trump, right or wrong about things, is certainly a mercurial personality. And I think the one thing we can rule out is that he's going to settle down and not continue this constant experimentation. I mean, they wanted to be generous. FDR, who say the Democrats, think was one of the greats, he was changing his mind all the time at the beginning. He was trying one thing after another. We remember him for what worked. We kind of forget about all the things that didn't work. Maybe, it'll turn out like that for Donald Trump. But I kind of doubt it on tariffs. I mean, I think he may have a successful administration in spite of the tariff policy, but not because of it.
Yeah, and I mean, it's helpful context that he has been consistent when it comes to tariffs. It just feels like maybe it was Wall Street that misjudged his conviction there on that point. But when it comes to the economic data that we've gotten thus far, and you think about
just one second. I mean, he kept changing his mind. I mean, if the tariff's going to be 150%, 50%, we get different answers for these things. I think there's a world of difference when tariffs get up to 20, 25% from when they're 10%. So, when it settles down, then we have a better idea.
Right. I hear what you're saying, Professor. Some pushback might be that 150%, maybe that was never truly going to happen. Maybe that was being used as a negotiating tool. But simply when it comes to the idea that he was going to put tariffs on, there had been some skepticism around that point.
Yeah, fair enough. And I think what economists would have said, I think most did, is that if he just quietly put on 10% tariffs, not the greatest idea, it's a tax, but really wouldn't be that big a deal for the American economy, especially if you cut taxes somewhere else. When you start getting up to 15, 20%, and I'd say especially 25%, it starts to make actually quite a material difference in most models.
Well, that's exactly where I wanted to go, because you think about the average tariff rate right now, 15 to 18%, depending on, what source you're looking at. I mean, what does that mean for the American economy? If we stayed even at these levels, Professor, where do you see that really making an impact?
Well, it's going to make an impact in our financial markets to the extent that you are running smaller trade surplus deficits. You have less money coming in. It's going to push interest rates up. Money coming from abroad was helping to hold interest rates down. I'm talking about long-term interest rates, not what the Fed's doing. I think we're also going to see it over the medium term, say a few years, not overnight, in how investors view the dollar as a safe asset. These tariffs, when it's harder to move money in and out of the country, even if you're talking about goods, they're connected to financial markets and it makes the dollar less attractive, again, pushing up interest rates. Now, of course, Trump administration has a lot of moving parts. There are dollar stable coins, other things going on. You can't just point at one policy.
How much more do you think our dollar, your problem, how much more do you think our dollar is going to weaken. We've already come, I guess, about 10% off of the highs, but you could argue that it was overbought. But we still have, right, the high debt, and that could be getting worse. Policy missteps, maybe the attack on Fed independence. Obviously, the tariffs. Is that going to devalue the dollar another 10%, another 20%?
So there's sort of two separate things. One is the dollar going to be the lingua franca of the global financial system? It reached a level of dominance 10 years ago, the likes of which maybe has never been seen. I think it's declined some since then. But remember, that dominance is held whether we've run deficits or surpluses, when the dollar's high, when the dollar's low. The dollar, as you say, Matt, was very high at the beginning of the Trump administration in terms of purchasing power. We haven't seen anything like it since 2002, and before that, 1985. And both times the dollar came off dramatically. I think after 2002, something like 40%. So 10% is nothing. I mean, I think the dollar likely is still going to weaken over the next couple of years, even if everything goes great. The dollar is still really richly valued. Conversely, you can point to currencies like the Japanese yen, which just can't stay as weak as they are forever.
I mean, especially if they raise and we continue to cut. And on that note, Professor, I want to ask you finally, if we do cut rates, and you've got to guess that, you know, if Trump gets his pick of chairs, that's going to help, 150 basis points, 175. Is that likely to stoke inflation? Does monetary policy really have that strong effect on inflation?
Well, if they get it wrong, it would. I mean, I think the consensus is that the neutral rate's gotten quite a bit higher. It's not what it was in the 2010s. We don't live in the ultra low interest rate era. There's a lot of debate around that, but I think it's shifted towards thinking higher for longer, certainly for long-term rates, but probably for short rates. So there are two ways to call it. I certainly don't think they're going to come down 150 basis points. That's on the high side. Even at the end of 2026, I think we're going to end up in a higher rate regime. I would look them to land at 3.5, 3.75. If they don't, yeah, we'll get inflation.
Thank you so much, Professor. Really appreciate your time. Ken Rogoff, there, Professor of Economics at Harvard University, of course, former chief economist at the IMF, and the author of Our Dollar, Your Problem. This is Bloomberg.
Welcome back to The Close. We have some breaking news when it comes to Intel, a company that we follow very closely here. The headline that the Trump administration is set to discuss the U.S. taking a stake in Intel. The reaction is swift in the stock market. Intel shares spiking about 7%. This is according to people familiar with the plan, and certainly this would be a big move.
Yeah, you've had the president mightily involved in the business of Intel, which has deteriorated significantly. I mean, this is a company that's lost half of its value over the past 5 years. But just a few days ago, you had the president demanding the resignation of Libby, the CEO of Intel, because of his, I guess, involvement with Chinese companies, Chinese investors, and then you had the CEO writing a memo to his employees saying he's got to explain what really was the case to this administration. But now it does look like the president wants the administration to take a stake. And this is important because Intel had planned to invest so much money, and it was really tied closely to the CHIPS Act of the Biden administration. And then they pulled back from a lot of those commitments.
Yeah, absolutely. And as you mentioned, I mean, this is a company, too, that the U.S. government poured a lot of money into to make that happen. We know that that White House meeting between the president and Libby did go well. That was the official readout. And the CEO of Intel was scheduled to meet with other cabinet members as well. Now we have this breaking news, again, that the Trump administration is set to discuss taking a stake in Intel. We will bring you more news there as we have it and continue to track that story.
I'll just point out that this spike today has pushed Intel again back over $100 billion in market cap, which
American
is
icon.
Really, no, I mean, it
Yes.
is an American icon, right? In terms of chip makers, this is one of, the big pioneers of the industry, but it has fallen down to, such a tiny market cap compared to behemoths like NVIDIA, which is now worth more than $4 trillion plus an Intel.
Yeah, exactly. So Intel really falling behind here, and the U.S. government apparently wants to take a stake. We will continue to follow that story. But let's talk about another icon. That's Deere. It's our stock of the hour. The stock headed for its biggest drop since 2022 after earnings, with the agricultural products giant warning its customers remain cautious. It also raised its tariff impact estimate for the fiscal year to $600 million from $500 million. Let's discuss with Bloomberg agriculture reporter Michael Hertzer. And Michael, it just feels like there's a lot here to sort through, because on top of course, all of those tariff impacts and the geopolitical winds shifting here, there's also the fact that grain prices have been depressed for quite a while now.
There is indeed a lot of kind of moving parts here. We're waiting for farmers to come back to the table, but at the same time, the market really took a downturn on corn prices as we look at a record harvest. Meanwhile, Deere is kind of saying that the tariff impact is sort of yet to come. So they might be looking at higher prices, costs, at the same time that farmers might be willing to engage at the dealership.
Michael, the costs, I imagine, are mostly steel tariff costs, aluminum tariff costs, but also I wonder how much of the componentry that goes into Deere equipment comes from outside of the U.S.
They highlighted, in addition to the steel and aluminum, they said the EU and India are the kind of main points where the costs are increasing. So I think there's some components as well that are part of that, but there's not a sort of great deal of detail that they shared on how that's all coming down.
And you think about, what Deere is facing. It doesn't feel like it's isolated to Deere. I have to imagine, Michael, that these sort of cross currents, they're a problem for a lot of the companies in your reporting sphere.
Yeah, I mean, if you look at seeds, fertilizer prices are skyrocketing due to tariffs and other issues, and there's a lot of volatility. Deere did make a comment today that for the outlook for North America, it's more uncertain than ever. So it's really kind of unknown how it all going to play out.
All right, Michael, great to have you on the program again. I know you've been doing double duty today. Bloomberg's ag reporter Michael Hertzer talking about Deere on a hot day for the story and a bad day for the stock. I want to get back to that breaking news on the Trump administration. Donald Trump, the president, saying he's in talks with Intel to have the U.S. potentially take a stake in the chip maker. Bloomberg's Tom Giles joins us now. And Tom, how likely is this to happen?
So this is really early days, but it would be a pretty momentous event and development in terms of new ways that the Trump administration is inserting itself into U.S. Industries. We saw it with the steel industry previously, and now with chips. Remember that the Trump administration wants to secure deals to show that in some way it's bringing manufacturing back to the U.S. Intel has had this manufacturing hub under construction in Ohio, but because of financial difficulties that the company has been having, they're cutting costs. They have fallen behind technologically. They have a new CEO who's come in and eliminating jobs. And there have been delays in the production of this chip plant, which again is about bringing jobs to the U.S. and it's about restoring our role as a leader in chip making, a role that we have ceded to other countries. This is the administration saying we want to find a way to help this company, this once iconic symbol of U.S. chip making manufacturing prowess. which has fallen behind. We want to help them, and maybe we do it by taking a stake. Remember, the Trump administration has not said anything publicly about this. This is based on conversations with people with knowledge of the matter. So these are early stage discussions. It's funding that Intel could certainly use at a difficult time in its life, and it's certainly a way for the Trump administration to claim another victory, another way that we're bringing jobs back, we're reinvigorating U.S. manufacturing.
Well, this is pretty remarkable, Tom, because I hear what you're saying. Intel needs funding, but the government taking a U.S. stake in the company is much different than just giving out grants, for example. You think about the CHIPS Act, and part of the reason why this is so interesting is because you think about the news that we got at the start of this week, that the administration is looking to receive 15% of certain chip sales when it comes to China. You think about NVIDIA, AMD, you have to wonder if this is something that we're going to see more and more of.
Look, the administration, for better or for worse, is trying new configurations. It's all about, hey, how can we generate revenue? How can I claim a victory here? How can I use my deal-making capabilities to score some somewhat unconventional and some would argue legally questionable deals, like was the case with the export deals with NVIDIA and AMD earlier this year, where the Trump administration would take 15% of revenue generated by sales of these certain chips into China. Remember, the government is concerned about Chinese access to advanced capabilities. Trump administration saying these are not the most advanced chips. These are not the droids you're looking for. We can let this go. We'll take a little bit of a cut from this. We're not giving China too much. And at the same time, it's another way for the Trump administration to generate some revenue. Again, if they take a stake in Intel, what does that mean? What kind of control does the Trump administration gain over operations at Intel? But again, look, this is a critical time. Even though the discussions are early, this is something that it's capital that Intel could certainly use.
It's, I think, fascinating, Tom, because you had the president essentially taking cues from the Chinese Communist Party, right? This is going to become maybe a state-owned enterprise.
State-owned enterprise.
He's already done this to some extent when he agreed to sell U.S. Steel to the Japanese. He's taken a golden share in that business, and he's shown signs that he really does want a centrally planned economy out of Washington. You have a wealth of experience covering companies for us here at Bloomberg. You're a senior executive editor for global technology. Can you see the U.S. continuing to go in this direction, the federal government growing larger instead of getting smaller as President Trump looks to decide the fate of winners and losers in this economy?
This is not capitalism. This is not your father's or your mother's capitalism or your grandparents' capitalism. It's a new and different kind. It doesn't sound very much like capitalism when you think about centrally planned economies. And we've seen what happens historically to economies when the government gets too involved in making those decisions. Is that the role of government? Historically, Silicon Valley has been very successful in saying to the government, you stay out of our business, we'll create jobs, we'll create new cutting-edge technology, leave us alone, don't regulate us. This is a very different paradigm. And as you know, in that deal earlier this week, as Bloomberg and others have reported, there are legally questionable sort of ramifications here. Is this kind of thing where you get a stake in exchange for the lifting of export controls? Is that constitutional? That still needs to play out. Government taking a stake in these big U.S. companies beyond something temporary, beyond a kind of a bailout, and how much does this resemble the kinds of things that we've seen in the past with, say, the auto industry? Very early days, we haven't seen any fine print. There's been no deal reached. But there is a dangerous precedent when you think about, does the government, should the federal government be in the role of deciding what happens within these companies? Are they going to have a board seat, for example? Are these the best people to be running companies when they're trying to also run government? when they're trying to negotiate trade deals with China, when they have a lot of other responsibilities, it's certainly not the way Silicon Valley has played its role with the government in the past. This is very much uncharted territory.
Right. All right, Tom, really appreciate you hopping on for that reaction. That is Bloomberg's Tom Giles. And just again, to reiterate what we're talking about here, this is a Bloomberg News scoop that the Trump administration is set to discuss taking a U.S. stake in Intel, which would certainly be a remarkable turn of events. For more perspective from Washington, let's bring in Bloomberg Balance of Power co-host Joe Matthew. And Joe, it's interesting, the sequencing here. When you think about earlier in the week, at the start of the week, getting the news that the U.S. is set to receive a 15% cut of chip sales in China from A&D, from NVIDIA. We know that the CEO of Intel specifically, Lip-Bu Tan, met with President Donald Trump at the White House this week, and now culminating in this report here.
Yeah, it's interesting looking back through this, especially the changing tone that the president had. We have to remember a few days before that meeting, Donald Trump was asking for Lip-Bu Tan to resign, citing what he called conflicts of interest. He said there was no other solution to this problem and he must resign immediately. That brought him into the White House, where they had apparently a very successful meeting. And maybe we should have expected some interesting news, because I'll go back to the post that the president made following their conversation. He sat down with Lip-Bu Tan and said his success and rise is an amazing story. Tan and my cabinet members are going to spend time together and bring suggestions to me in the next week. Apparently, one of those suggestions was to take a stake in the company. And as Matt mentioned, this follows the idea of the golden share with U.S. Steel. It follows, to your point, Intel or NVIDIA and AMD with their 15%. Creative ideas, as Peter Navarro put it to us the other evening here when we were talking about this on Balance of Power, will continue to come out of this White House. This one is a pretty shocking one, though.
It is, I think, a little unfair to compare it to a nationalization. I don't think that's likely the idea, Joe. But it does look like, as Tom Giles just reminded us, that maybe President Trump is taking a page out of President Obama's playbook. Remember, after the great financial crisis, the U.S. took stakes in General Motors and Chrysler, as well as AIG, Citi, Fannie and Freddie, that they still hold. So it's very interesting, isn't it?
Well, and he was lauded for that, of course, and maybe Donald Trump wants to be able to say, I saved the chip industry. But Intel has run into a lot of problems of its own. It's not like he's taken a stake in NVIDIA here, remembering that the CHIPS Act gave $8 billion to this company to build this massive fab in Ohio. And at the time, Republicans were decrying Joe Biden's move here, Democrats' move here. Even though the CHIPS Act passed in a bipartisan fashion, he was criticized for picking winners, quote unquote, because he picked the wrong company. I think a lot of investors came to agree. Look at the stock action since that announcement took place. So look, let's find out. Would Intel go out of business without the United States? That was the claim at the time when the U.S. invested in GM.
I can tell you certainly that Central Ohioans would be happy for that investment to go back to $30 billion. Balance of Power co-host Joe Matthew, very much looking forward to your program on Bloomberg Television and Bloomberg Radio. That kicks off at 5 p.m. It's a show I listen to every day.
I know you do.
Yeah, I like the radio version. You can watch it on TV, though, as well. Joe Matthew always has a fantastic slate of guests at 1 p.m. and at 5 p.m. Definitely tune in for that.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
About 2 minutes away from the end of the trading day, Matt Miller here with Katie Greifeld to help take you through the closing bell. We've got a global simulcast. We're joined now by Carol Masser and Tim Stenevec, bringing together our Bloomberg Television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the trading day. And Carol, I've got to say, the biggest headline that I've seen today is not PPI, but the Trump administration possibly considering taking a stake in Intel.
I was like, my mouth was wide open because I'm trying to pick my jaw off the floor. I mean, oh my God. In Intel shares up more than 7% on that news, Matt, that the Trump administration in talks with Intel to make a stake in the company. We just talked with Ryan Gould. It's not happening yet, but it sounds like there's a lot of conversations happening.
It's a new era when it comes to government involvement in American companies. Ryan brought up the example of U.S. Steel and the golden share there. We spoke weeks ago to James Litinsky over at MP Materials with that $400 million investment from the Department of Defense. This is completely different. It turns conventional wisdom on its head about the way that investors are thinking about the U.S. government and its role in commerce here.
Yeah, and American capitalism and what that actually means. We were also just talking about the sequencing of it all with our own Joe Matthew, talking about, think about this week. We started the week with that news that AMD, NVIDIA might give up 15% of their revenue from China chip sales to the U.S. government. We know that Libby met with Donald Trump at the White House. Perhaps this is one of the topics that came up.
Yeah, I think very interesting considering the CHIPS Act has been so harshly criticized by this administration, but taking a stake in this company, not typically something that Republicans are behind. You hear and see the closing bells on the New York Stock Exchange and at the NASDAQ market site, the Dow Jones Industrial Average closing unchanged at 44,911. The S&P 500 also unchanged, but at least with a green arrow there, 6468. So holding at record highs for the S&P 500. The NASDAQ, even less change than the other two right now, 21,710. That is also holding right around record territory.
Yep, just quick check on small caps, too. We're seeing that index down about 1.25% in today's session. But if I go back, Katie, to the S&P 500, most names lower in today's session, 360 losing ground, 141 to the upside.
You know, we were talking about mid-caps earlier. It was titillating. Let's talk about sectors, though. This is interesting.
What index even is that?
It's the S&P 400 mid-cap index. Remember that name. Anyway, you take a look at sectors right now. It's pretty much a lot of green, a lot of red. What is leading, though? Financials today having a good day. So, too, did consumer discretionary. What isn't doing so hot? Industrials not having a great day, nor did consumer staples, but almost an even split there, Carol.
Do you know what is doing really well today?
I was hoping you'd tell me.
Number one gainer, Intel. Let's go right to it. That stock up as much as almost 9% today, finishing with a 7.4% gain. Again, it's that story that our team just put out about the Trump administration in talks to have the U.S. government potentially take a stake in the beleaguered chip maker, helping support the company's efforts to really expand domestic manufacturing. Again, according to people familiar. Maybe we'll go back to gainers, but Matt, you've got some earnings related to the chip
I mean, since we're on chips, and I know a lot of people watch this show for the breaking earnings news at the close, we've got Applied Materials coming out with third quarter semiconductor system sales of $5.43 billion. The estimate was for $5.39 billion. The revenue on that level just a little bit stronger than expected. Net sales were $7.3 billion in total, and that beats the estimate by almost $100 million. $7.21 billion was the estimate, so better than expected on the sales side in terms of getting down to the bottom of the income statement. Adjusted EPS, $2.48. And we were looking for 236. So 248 over 236 is a beat for AMAT. And is that enough to move the stock in the after hours trade? Well, it's moving down, though. If it beats on the top and bottom line, it should be moving up. We have to dig into this statement to figure out what's going on at AMAT.
Yeah, pretty negative in terms of the trade that we're seeing here in the after hours. All right, folks, I'm going to go back to some of the stocks on the move here. I mentioned Intel, which was the number one gainer in the S&P 500. Got to talk about some of the IPOs. We've seen some flow this week in a big way. MIAX, ticker is MIAX, having its first day of trading its IPO. The exchange operator became the most recent financial services business to really get a warm welcome on Wall Street. The stock closing with a nearly 34% gain in today's session.
Is it weird?
What?
Well, that an exchange operator would go public on another exchange?
You know, Matt, we're living in weird
It's so meta.
times.
It is.
Am I wrong?
It
You're
plays
not wrong.
a lot into derivatives.
Can you go public on yourself?
Doesn't it play a lot into derivatives and options? And I don't know, maybe it's another option?
I mean, yes, you can go public on your own exchange, right? We see that with
ICE.
all of the other exchanges.
Yeah. So why don't they?
I don't know.
Speaking of exchanges, how about Bullish?
Let's go to Bullish, another IPO this week. Well done, well done. That went up another almost 10% in today's session. That's after at its highs yesterday, more than 200%, but really rallying for a second day. So yeah, it's been kind of a good week for IPOs. So let's go to those that didn't do so well.
Yeah, John Deere tumbling today, down as much as 8.4% earlier in the session, down 6.7% on the day. The company trimming its annual earnings outlook. In fact, lower grain prices are causing struggling farmers to delay buying new machinery. That hitting the company's top line. Deere also saying tariffs, such as those on steel aluminum, are eating into profits in segments for small agricultural and turf, as well as construction and forestry. The company did estimate that tariff costs for the fiscal year would be $600 million. That's up from a previous estimate of $500 million. Coherent down 19.6% today. It's the optical materials and semiconductor device company. Shares fell after the company late yesterday gave an outlook that some analysts said was underwhelming. It also said it would sell its aerospace and defense business to Advent for $400 million. Companies that call Coherent a supplier include Cisco, HPE, Dell, Nokia, NVIDIA, Apple, and more. And finally, Tapestry. It's the parent company of Coach, Kate Spade, and Stuart Weitzman. Shares fell as much as 18% earlier in the session. Today, down 16% at the end of the day. Tariff costs, weakness when it comes to the Kate Spade brand. The company's Coach brand is still doing well, but President Trump's tariffs weighed on profit, on a profit outlook that trailed estimates, according to some analysts, Katie.
I will say that Tapestry did have a very high bar to clear. I think coming into earnings, their shares were up something like 50-something% year to date. Actually, they're still higher by 50% year to date, even higher heading into earnings. I do want to quickly talk about Hims & Hers Health dropping after hours right now, currently off by about 2.4%. We just got this headline that Hims & Hers is being probed by the FTC over cancellation practices. Don't have much detail beyond that headline, but you can see traders reacting to that in the after hours. Shares currently off by about 2%, Matt Miller.
I should point out, too, that there's a couple of press releases crossing in terms of law firms involved, I guess, class actions against Hims & Hers, and it has to do with false or misleading statements. Hims & Hers was engaged in the deceptive promotion and sale of illegitimate knockoff versions of Wegovy. So it gets into kind of their core business. Anyway, there's a lot of detail in there, but it's all starting to trickle out. And that stock is definitely.
I dodged a bullet there, right? I was just about to buy that stuff.
Oh, no.
Take a look at the yields.
No, there's not necessarily anything wrong with the drugs. It's just what they were doing.
And there's nothing wrong with you, Matt. You look great.
Thank you very much, but I want to avoid heart disease and Alzheimer's. Take a look at the bond yields here. We saw a flattening of the curve today. The 2-year yield rising much more than the 30-year yield, but also more than the 5s and the 10s. So 373 basically on the 2s as investors expect less of a cut, let's say, in September than maybe they did yesterday.
Maybe not 50 basis points either.
Exactly. Maybe not that. But still, I think we're pricing in almost one full cut, right?
All I'm going to say is there's a bunch of things to get through. Jackson Hole, some more data reports before we get to
more jobs, another CPI, another PPI.
Yes, right, exactly. I got to go back to Intel because it was the number one gainer in the S&P 500, finishing up 7.4% in the regular session. It's up another 1.8% in the aftermarket. Our team of Ryan Gould, Josh Wingrove, and Leanna Baker out with the story about the Trump administration considering maybe taking an actual investment stake in Intel. This is according to people that they've talked to.
A question I have is, obviously, an infusion of cash would be huge for the company. Cash is cash, and the question though that I have is it a bigger story about Intel and what Intel needs to do in order to turn itself around? Is cash enough to do that?
There's a lot of questions that I have. I think it's a bigger story for Intel, like you said. It's also a bigger story for just how the U.S. government gets involved with American companies. I mean, this is pretty wild. And you think about all the different ripple effects here, Matt, you could get dizzy.
Republicans today are very different than Republicans in my youth. But look, they don't really need to turn around the company, right? They just need the cash to do the investment that they had been planning on doing before the CHIPS Act got killed. That does it for our cross-platform coverage of the market close on Bloomberg Television, radio, and YouTube. And a reminder that Bloomberg Business Week Daily is now on Bloomberg Originals. We'll be back tomorrow at the same time, same place.
Coming up, tariffs making waves in a host of industries, including boating. We'll speak to the CEO of Malibu Boats on the state of the consumer. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Matt Miller. We're in for Romaine Bostick and Scarlett Fu. Let's take a look at where the markets closed today.
Yeah, why not?
I mean, on the index level, it's totally boring. Although we did have a new closing high on the S&P 500.
On.
We're 2 points higher than we were yesterday at 64.68. If you want to round up, 64.69. The NASDAQ didn't close at the high level we saw yesterday, but it's about there at 23,832. Small caps?
Yeah, how about those small caps? That's ugly.
Getting hammered today, obviously because we maybe don't expect 50 basis points of rate cuts in September, more like 23 now, and the 10-year yield rising, not as much as the 2-year, but not as little as the 30-year. Right now, 428.29 is your level.
All right, let's talk about some of the individual movers on the day. Kind of an IPO theme here. I pulled up Bullish. That's a crypto exchange, really geared more towards the institutional set than maybe some of the retail platforms. Doing well in its debut. This is its second day of trading, I believe, rising about 10%. CoreWeave, one of the hottest IPOs this year, falling over 15%. Its lockup actually expires after the close today, so maybe some selling in anticipation of that. And Intel, of course, we're talking about Intel here. We did get the news from our Bloomberg News team that the Trump administration is said to discuss taking a stake in Intel. That came just in the last few minutes of the trade, and it boosted Intel shares by more than 7% into the closing bells, Matt.
Yes, now they're up by 20% year to date. Let's bring in Shelby McFaddin. She's an investment analyst at Motley Fool Asset Management. We're lucky enough to have her here in studio when this breaking news crossed, Shelby. I mean, what a story. What are your thoughts on the potential of the U.S. government taking a stake in really this iconic chip maker that's been doing so poorly?
So many thoughts. As an individual, the first thing is what is going on with the state of capitalism. But as an asset manager, which is my first duty to our clients and our investors, I'm thinking about our models and I'm thinking about what it means for fundamentals. So first and foremost, there's a lot more news that has to come out for this news to settle in. We have a lot of questions that still have to be answered. And so therefore, we can't make any snap decisions, right? So we did see the market making an initial snap decision, right? Plus 7%. And that sort of leans right into the second thing I'm thinking about, which is we have not been trading on fundamentals for a while. We've got a lot of froth. When we see things like waiting for the Berkshire Hathaway report, even though that is something that we've trusted for a long time, we know that he's one of the most intelligent men who's been in the investing space, it's still not fundamentals, right? It's waiting for another signal apart from what the companies can just put out themselves. And so this has just been another example of watching for what we think these other triggers might mean for a valuation opportunity, as opposed to what are the companies doing to drive their profitability and their cash flow. So apart from the whole changing infrastructure of it all, when we just drill into what is the market doing with this information, it's telling us that hopes and dreams are starting to matter a lot more than what the companies can just go ahead and put out themselves.
I mean, to that point, Bloomberg's MLive desk did a survey, the Pulse survey, yesterday, and one of the questions that they posed to investors was, what effect is the president's weight on rates going to have on the stock market? Like, if Trump convinces the Fed to cut rates, not based on fundamentals, but just because he wants them to, is that good or bad for stocks? And 59% of investors that we surveyed said that's great news for stocks. I wouldn't have expected that outcome, right? This, putting the full weight and credit of the United States federal government behind Intel, as Tim was pointing out in our simulcast, maybe not a proven strategy for the company's turnaround, but it's definitely going to be good for their balance sheet and the investments that they need to make.
Yeah, and I think it's interesting because we have seen so many more retail investors come into the space, and it's coming in droves. And one of the discussions we've had is that the stock market is looking a lot like the way that we explain inflation, right? It's a fixed number of assets or goods and a lot more money chasing after it. And we're starting to see that in the securities market, right? More interest in investing and a lot more money chasing after it. It's going to drive up those valuations. And so similarly, you have the driving up of sentiment. Everyone's more excited to invest, right? And the stock market's great, right? It's a mutually beneficial relationship. That's the whole point. And it's frankly how most of us save for retirement. But there is a consequence of increasing amount of investment. It's going to tend to lean more towards sentiment than fundamentals. And this might be a long-term sort of change that we have to adjust to. And so it's not surprising to me to hear that the cutting of rates just sounds like a cash register. And it just seems like, sure, we don't need to think about real. We can think nominal. Nominal looks good to me. I think that's something that's overwhelmingly taking course in the market.
Well, let's bring this conversation to individual securities, because you highlighted a few stocks in your notes, Toast, Ulta Beauty, Costco, as a place you're positioning here. What's interesting to me is that these all kind of touch on the consumer, but from different angles.
Yeah, and it's been really fun to be in the consumer space, especially in this time, and to be in small and mid caps, which Toast and Ulta both occupy that space. They're in our TMFX product, small and mid cap growth. And the opportunity we find there is that inherently, these companies should grow. They should land themselves into upper mid-cap to large cap range. And so even though they're going to be a little bit exposed to the cycle, we're trying to find companies that are doing it best. And so when you look at Toast, you realize that even though we saw a little bit of belt tightening from the likes of Cava and Chipotle, people still increasingly are eating out. That's a little bit more exciting, especially when you can't do things like bigger trips, when you have a little bit smaller budget. And so when you have companies that are able to support small and medium restaurateurs to make the experience mutually beneficial for them as business owners, but also customers, to keep that stickiness and to help sort of reduce the elasticity of demand there, you get an opportunity. And then they also have that opportunity to eventually start selling up into enterprise. So we've seen something like that from the likes of Shopify, where they were sort of this dark horse that was focused on small, but now they have this opportunity to sell up to enterprise at exactly the time when enterprise companies want to spend less on this type of software. So we hope to see that type of opportunity with Toast.
And we don't have a ton of time left, but I do want to go back to Toast. You touched on this point already, but Cava got absolutely hammered this week. Chipotle also didn't fare so hot in its recent earnings report.
Hang on.
Go on.
You had Cava for lunch. How was it?
It was okay. It was okay. I'll leave it at that. But anyway,
that was unplanned.
When you see those sorts of reports and you see those numbers and you see the stock reaction, does that give you any pause on a name like Toast? How did you receive that news and then apply it to your analysis on that specific company?
I think when we see that type of news, you have to sit with it for a second. We have to ask ourselves, what are the unique things? What does this have to do specifically with those companies? And then also realizing that Toast is going to cater oftentimes a little bit more to some of the independent or local chains. So knowing that there is a small amount of separation, and then also knowing that there are companies that have grown really, really fast. And then the fun topic that we had a discussion about earlier, just bullflation, right? So looking at the fact that there are so many opportunities to just get that fresher, more healthy seeming bowl, you don't have as much space to continue raising price. And so you eventually hit a wall. So you have to kind of separate the overall dynamics of how much discretionary income the consumer has for food service versus what's going on in these specific companies and their competitive dynamics. And I think in doing that, we can still see the opportunity in Toast.
I can't go higher than $20 a bowl. I'm at my limit.
Far too much.
There's no more
And what kind of tip?
Power.
I mean, speaking of Toast, that's where they ask you for a tip, right?
It is.
So what do you put?
I mean,
what do you put?
I put 20%.
It depends on what you're getting. I'm going to be honest. I know I might get some fire for that, but if it's a drip coffee, I don't know, folks.
It seems like a lot for them just to hand you something.
But they assemble it in front of you.
Shouldn't the employer pay them?
Probably. Shelby, it's great to have you with us. Really appreciate your patience as we dealt with some breaking news there. That is Shelby McFaddin. She is an investment analyst over at Motley Asset Management. And coming up, tariffs making waves in a host of industries.
Making waves.
Including boating. We'll speak with the CEO of Malibu Boats, Steve Menneto, next. This is The Close on Bloomberg.
All eyes on the state of the consumer. Wholesale inflation jumping by the most in 3 years following a largely benign reading on consumer prices. Investors now turn their attention to tomorrow's retail sales report for another readout on how U.S. households are feeling about the economy. Well, here with more insight is the CEO of Malibu Boats, Steve Menneto, and formerly running the Indian motorcycles business. Steve, if I have any extra cash, it's basically going to the enterprises that you run. But also, I would need to take a loan probably to buy most of these products, and rates are really high. So with that backdrop, what does the consumer look like to you right now?
Yeah, thanks, Matt, for having me on. The consumer's a little challenged right now, of course, as you just pointed out. Pricing has been inflated a little bit, of course, with some of the costs that came through COVID, also with some of the tariff costs and so on, as well as the rate increases. So as those rate increases took hold, we started to see that payment buyer kind of go to the sideline and really waiting, and which resulted into a pretty choppy marine industry.
It is pretty choppy. There were certain segments, and I'm not talking specifically about Malibu Boats, but that did well for the industry, right? The high-end performance, like wakeboard towing boats that you make with Malibu and Axis, and you have obviously competition, I guess Mastercraft and Nautique, right? That has seen real growth, and I wonder if you see that continuing.
We see the growth in our towboat segments. Malibu also has 7 other different brands that we manufacture and sell through a dealer network. So we see it in our Cobalt brands. We see it in our Pursuit brands. That cash buyer is still strong. They're still coming to the market. The more feature-rich boats, we continue to see that across the industry, not just in our brands, but also in our competitive brands. We see that feature-rich boats being in demand, and as well as, like we said, the strength of the cash buyer is still there and driving the market.
When someone is looking to buy one of your boats or a boat from one of your competitors, it's a healthy chunk of change. What is the average price of a wakeboard towboat, and what are rates looking like right now?
When you look at average price in our overall industry, towboats, they can range anywhere, from $80,000, up into almost $300,000. Some of our competitors will sell a towboat for $500,000. So there is a lot of opportunity to buy at whatever that consumer wants, depending on the features and size of the boat.
But rates,
where the rates,
yeah. If I've got an 800 credit score, Steve, what am I getting for? I don't know, how long is the loan term?
You can, an 800 credit score, you can still, it's probably still going to start with a high 6, low 7 rate. And you can go, on average, they go 10 years. Some people go out to 20 years on boats. But that's kind of where it starts. And so there is, we're trying to create financial products for all different customers.
Matt, are you asking for a friend or specifically for yourself?
I mean, it is so much fun.
I think there's a conversation after.
Yeah, I'll definitely call you after. No, it is so much fun. And I know you have, Steve, another, you have other segments. You have the stern drive boats that you sell, as well as the, outboard, the fishing boats that you sell. But for me, it's the wakeboarding.
It's the wakeboarding. I did want to ask Steve really quickly. We have less than a minute left here. I know that your main market is the U.S., but what does the international landscape look like for you?
Yeah, we do sell actually to 40 different countries. We have distribution internationally. The size of the boat industry, recreational boating, particularly towboats, is not as big, right? There's a lot more commercial boating. There's a lot more fishing and so on. So when you look at Malibu and Axis, those types of boats, Cobalt, we do sell overseas. We just don't sell as much as we do in the fish market.
Maverick and Pursuit, and those are the brands.
Correct.
All right, very cool stuff. I hope to get you back when you have earnings. I know I was looking at your fiscal Q3, and you saw a 70% jump in the performance wakeboard towboat revenue. So we'll see if that continues. Steve Menneto there, the CEO of Malibu Boats. Sticking within the vehicle space, tomorrow, you don't want to miss our conversations with both the CEO of Bentley and the CEO of Lamborghini. Those will both be on Bloomberg's Open Interest. Plus, you can catch my weekly podcast with Hannah Elliott. It's all about cars. It's called Hot Pursuit.
This is Bloomberg. Welcome back to the close. Let's take a look at Intel. You can see its rally is extending into the post-market trade. with the Trump administration reportedly considering taking a stake in the company. Joining us live on set is Bloomberg's U.S. deals reporter Ryan Gould, who helped break this story. So, Ryan, fascinating, obviously, and you can see traders digesting this news in real time. Talk to us about what exactly we should think about this as, because, you know, we got the news earlier this week that the administration has reached an agreement to receive 15% cuts of certain semiconductor sales to China. We know that they took a so-called golden shares in U.S. steel. Where does this fall on the spectrum? Should we think of it as a golden share, or what are folks telling you?
I think it's very early still. It's really hard to tell exactly what form this will take. I mean, one of the other things you might want to throw into the mix is the MP materials deal. I can tell you in the conversations that I have had over the past couple of days around this situation, the MP materials deal is a very good sort of way to think about what this could look like. I think the MP materials deal was a very good indication as to how the Trump administration thinks about strategic importance of private businesses. When I say private, I mean non-government, non-public sector businesses in the United States. I mean, you saw on the back of that deal that MP, which received the investment from the DOD, rallied almost 50% on that backing. So I think it's still kind of early, and there's going to be a lot more to digest, but this is certainly a new dynamic.
Can you look at U.S. investments of the past? And clearly the great financial crisis was, well, hopefully that was a very different backdrop than we have right now economically, right? But the U.S. did take stakes in a number of big companies, General Motors, as I said, Chrysler, AIG, Citi, and some of them it hasn't even finished divesting yet. So I don't think we expect a wave like that to happen again.
No, I don't think so. I think maybe another way to think about this is that just in a similar way that some of the banks are too big to fail, if you think about semiconductor importance to the United States and therefore the rest of the world, Intel is the U.S.'s almost single hope when it comes to, you know, having a manufacturing plant for chips in the United States. It's an incredibly onerous and very capital-intensive task. And so I think if you think about how important it is that we have that onshored in the United States going forward for the next 10, 20, 30 years, I mean, it's vital. You think of some of the things as well that Intel's facing. I mean, Libby cut a very interesting figure on the most recent earnings call for Intel, saying that, you know, they were trying to sort of right-size the house financially. Yeah. But the Ohio plant became a big focus on Pat Gelsinger, the guy who sort of stepped down prior to Libby coming in. And that was kind of seen as the next sort of avenue. That's what they wanted to really focus on as being a shining light in the United States.
It was supposed to be a $30 billion investment in the greatest state in the nation.
In Ohio, specifically.
Yeah. No, nonetheless, the great state of Ohio, and it's since been pushed back, keeps getting delayed. So we do know from our discussions that that project, the Ohio project, is and has come up in these discussions with the U.S. government. So it'll be interesting to see how that plays out.
Well, that's the thing. You think about earlier this year, that build out, it was delayed until the 2030s. And you make a good point in bringing up the earnings call, because it seems pretty uninspiring. It was all about cutting costs. Tan, of course, took over in March, and it seemed like the Ohio factory and that expansion there definitely wasn't at the top of his list of priorities.
I think that's true. And I think if you were a banker or a lawyer or any other person advising Intel right now and the board as to what their options are, certainly, you know, whether within or without the discussions of the United States government, I think this is kind of just, we put it in the story, there's a sense that this could turn conventional wisdom about how to think about outside capital coming into private companies will work going forward in the United States. For a variety of reasons. This is surprising investors, it's surprising analysts, it's even surprising some in the industry who compete with Intel. So I think there's still a lot of wood to chop. These discussions are early. And, you know, Intel, I should note, that hasn't really commented on the discussions, but it has said that it looks forward to continuing to work with the Trump administration on what they call their shared priorities in and around strengthening U.S. technology and manufacturing.
That's amazing what a meeting at the White House can bring you. Ryan, great to have you on. Thanks so much for joining us. Ryan Gould is a U.S. deals reporter. He helped break this Intel story for us. Let's bring in Bloomberg opinion columnist Jonathan Levin to talk about what this means, you know, for not just Intel and the Trump administration, but the state of capitalism in America. Are we going too far to say that this is un-Republican, Jonathan, to say that the government is going to start taking stakes in companies and deciding who wins and who loses?
I don't think we're going too far at all. I think this is totally shocking coming from the Trump administration. And I think, unfortunately, it probably tells us something about where this administration is going. You were right earlier to bring up the financial crisis, Matt. But that was a totally different set of circumstances. That was a crisis. We are very much not in a crisis, much less a recession at this moment. And it seems like the Trump administration is just trying to put its thumb on the scales everywhere. It's not just, this potential deal that our colleagues are breaking here today, as well as, what you mentioned with chip exports and the steel industry. But, in other ways, this administration is sort of picking favorites with tariffs, trying to put its thumb on the scales in the longer end of the bond market with the Genius Act and other things and so forth. And so it's just, I'm a free market guy, and it's nothing short of shocking coming from a Republican administration when you step back and look at what's happening here.
Absolutely hear you on that point. I do want to talk a little bit, though, about even prior to this week and what we saw specifically in the chip sector when it comes to NVIDIA, AMD to start the week, now with Intel. I mean, it was clear that this is an administration that CEOs want to curry favor with and have a good relationship with. You think about, of course, NVIDIA, going back to NVIDIA, CEO Jensen Huang's relationship with the president, with the administration, Apple, too, the experience with Tim Cook. Beyond what we're talking about here, cuts of revenue when it comes to direct stakes, as well as we're talking about with Intel, just in terms of the different types of policies that are being put on when it comes to tariffs. Clearly, the relationship with the Trump administration matters. Maybe it always matters in every administration, but it seems particularly urgent when it comes to the Donald Trump administration.
Yeah, that's a great point, Katie. I mean, that's just another form of intervention, slightly less explicit, but nonetheless corrosive, right? I mean, you're creating an economy in which those who have access to the Oval Office, those who have access to Mar-a-Lago, potentially get privileged treatment, or at least we know that they get the president's ear, and everybody else does not. I mean, look at this economy and look at this market, right? Large caps continue to do great. We're coming out of an earnings season that has been nothing short of spectacular. These folks with access and with market power are doing very well. But what does this kind of economy mean for small businesses? What does it even mean for smaller and medium-sized public businesses, right? The Russell is not exactly setting the world on fire. And, I wonder if that's telling us something about what's to come in this administration.
Well, and you say, we're not in a crisis, Jonathan, but this administration is desperate for rate cuts. Why do you think that is? I mean, the Treasury Secretary yesterday was basically looking at the warp function on the Bloomberg when he said 150 basis points, but the president has called for 300 basis points of cuts. That, to me, would signal an absolute economic crisis.
Yeah, it makes absolutely no sense unless you're just Donald Trump and you spent a lot of your career in a world where folks were getting 4 or 5% mortgage rates, and now you look out the window and you see it doesn't look anything like that. We got the PPI today. Elements of it were certainly concerning, but it's probably not as bad as people think. A lot of the heat came from final demand trade services, which we know is an extremely volatile component. Core PCE is probably going to print 0.3%. We're in an environment in which inflation is not terrible, underlying inflation, but it's not great. And there's still a risk as we head into the back end of the year that we're going to see some more of that core goods inflation. And that's an environment where you're cautious. You're not slashing rates back to neutral in this environment. Maybe, reasonably we get 1 or 2 cuts in 2025. But these people out there kicking and screaming and saying, we got to do jumbo cuts in September, I just don't see it.
All right, Jonathan, great to get some time with you. Really appreciate it. That is Bloomberg opinion columnist Jonathan Levin. And let's keep this conversation going now with Libby Cantrill. She is Managing Director and Head of Public Policy over at Pimco. Libby, great to have you with us. We're still trying to wrap our minds around this breaking news from Bloomberg News that the Trump administration is said to discuss taking a stake in Intel. You marry that together with the news that we got at the beginning of this week that the government is set to receive a 15% slice of revenues from Chinese chip sales made by NVIDIA and AMD. I wonder how you're thinking about those two items and what could be coming. How does that change your understanding about how the U.S. government, specifically the presidential administration, is going to interact with American companies?
Yeah, well, nice to be with you. I think like everything, the devil will be in the details. I think it's really important, though, to point out, particularly as it relates to the Intel news, that the president may not be able to do this unilaterally. Just keep in mind that Congress still has the power of the purse enshrined by the Constitution and then codified by various different statutes along the way. And so the president may be interested in taking a share of Intel, but as it relates to a direct investment, that would most likely require Congress. So I think just from a preliminary basis, we should maybe reserve judgment, just given that those details would need to be outlined and finalized. I think that as it relates to the NVIDIA deal, again, that also might be in violation of the exports clause of the Constitution. But there might be some fungibility there. I think.
And it does look like the Supreme Court is apt to side with President Trump, regardless of what the Constitution says. I wonder if you can imagine an export tax for many other big businesses. Will this become the norm if the president gets his way?
Yeah, I mean, I might push back on that assertion. We've certainly seen the Supreme Court side with the president, but also not. So I don't think this is necessarily sort of open and shut from that perspective. But this obviously does just broadly, indicate a president who is willing to transact. This is sort of the transaction man in play, and as a result, it is a clear signal to American companies that having engagement with this White House is going to be important. But again, I think that we should reserve judgment until we do see the finer print, because I think there are a lot of details that do need to be filled out really before we can sort of assess the viability of this and the likelihood of it.
Well, speaking of transactions, one of the other big news items out there is that apparently the government plans to IPO Fannie Mae and Freddie Mac. This has been anticipated, speculated about for some time. You just have to look at the share chart to see that speculation. But Libby, when it comes to really paying attention to the details too, this is not a sort of open and closed process. There's a lot of hurdles to jump through here as well.
There are, and I think, and just zooming out, I mean, the U.S. mortgage market is in many ways the envy of the world, and Fannie and Freddie have a lot to do with that. They are incredibly effective in ensuring liquidity in the secondary mortgage market. So I think we as agency MBS investors really take the approach of doing no harm. Whomever controls Fannie and Freddie, we want to ensure that there is no disruption to the mortgage market. That was echoed by Secretary Bessent over the last 24 hours as well. So we very much share that view. I do think, again, not to be the negative Nancy here, but when you actually look at the details and the complexity of Fannie and Freddie, and again, the public good that they serve to the broader home market, housing market, I think that there will likely be probably more questions than answers here. And I think broadly speaking, our view is that while an IPO is certainly possible, a fall timeframe seems really aggressive in terms of regulatory capital, in terms of some of the rulemakings that we think would need to be, in the works. So I think bottom line here is, again, while these make great headlines and certainly help with the share prices of the common and preferred, again, overuse of the statement, but really the devil will be in the details. And we think on this front, probably a lot more to do than maybe the market, expects at this point.
Libby, you're so focused on policy, obviously, for Pimco, but decisions about the Fed, well, the replacement for Adriana Kugler's seat, as well as who will be the Fed chair. They could be one and the same. They could be different people. Since we know Stephen Myron is only temporary, how do you think that affects the FOMC? Because the administration is calling for, and the market has priced in, rate cuts to the point that would bring the terminal rate below the current level of core CPI.
Yes, I mean, well, I think a couple of things. One is that just don't forget that there is this advice and consent role of the U.S. Senate. So whomever is nominated by the president will also have to get confirmed not only by the broader Senate, which would require 50 votes, but also they'd have to get through the Senate Banking Committee. And because of that very narrow split, whomever is nominated, Stephen Myron, for instance, cannot lose even one Republican vote, assuming no Democrats vote for him. So there is still a long way from here to there, if you will. We don't think that, regardless, should he get confirmed, we don't think that Stephen Myron probably will be on the Fed by September. So that puts him on, the FOMC, a voting member of the FOMC probably by the end of October. But I think the broader point here, and something that we are very much reinforcing to our clients, is that while, a Fed official, Fed governor is, of course, an important voice, they are just one voice. And, there are 12 voting members of the FOMC. The chair obviously has sort of a disproportionate impact, but still is only one person. So I think that, while there have been concerns about, the personnel being kind of the policy, it's just important to zoom out and remember that, again, there are only one or two voices on a Fed, and there needs to be a majority vote, of course, to change monetary policy.
All right, Libby, thanks very much. Libby Cantrill there, Managing Director and Head of Public Policy at Pimco. Looks like we are getting some news here on Berkshire Hathaway talking about 5 million share stake in United Health, which is interesting not just because of we care about what Berkshire Hathaway does, right?
We care deeply about that.
Of course we do, but also interesting because of, the tanking in United Health shares that we've seen year to date, down almost 50%.
Yeah, we know it's been a really difficult period for health insurers. United Health Group shares absolutely surging after hours, though, if we can bring those up. After that news from that Form 13F from Berkshire Hathaway, United Health shares up 8% after hours. So we care what Berkshire Hathaway is doing. So too do traders, and you can see a lot of them following Berkshire Hathaway's lead here.
Use GIPA or GIPO?
I use GIPO.
Yeah, Carol does too. I've always used GIPA.
We're both from New Jersey too. Did you know that?
What a fantastic place that is.
Yeah, it's not quite Ohio,
especially
but
central,
we try.
especially central New
you.
Jersey. Ken Rogoff of Harvard in Boston, saying earlier that it's unlikely the Fed will come down 150 basis points, as Treasury Secretary Scott Bessent had suggested they might take a listen.
I certainly don't think they're going to come down 150 basis points. That's on the high side. Even at the end of 2026, I think we're going to end up in a higher rate regime. I would look them to land at 3.5, 3.75. If they don't, we'll get inflation.
Here to discuss further is Dana Peterson, chief economist at the Conference Board. And Dana, how much does this discussion actually affect consumer confidence? Does the average consumer pay attention to what Ken Rogoff or even Scott Bessent thinks about what the Fed will do over the course of the next year?
Probably not, but consumers do pay attention to interest rates. So they look at the mortgage rate, which has come down quite precipitously this year, but still affordability is quite low. They also do look at credit card rates, and credit card rates in some sense are adjusted based upon what the short end of the curve is doing, but also the longer end. And so overall, rates are just high. And so I think for consumers, they're feeling that when they're going to access credit to purchase things.
But Dana, where are we seeing that? You think about just headline measures. I know that we're going to get retail sales tomorrow, for example. You can see it in certain earnings reports that we're getting from specific companies. But overall, it seems like the consumer is still spending, still finding a way to reach into their pocketbook.
Yes, consumers are spending, but not like they were last year. Indeed, we had a lot of volatility with headline GDP in the first half of the year. But when you looked at consumer spending and you averaged it out, it was slightly slower. For tomorrow, we could have a very strong retail sales report overall because people went out and bought cars, and they especially bought foreign cars, trying to get those purchases in before deals are settled on tariffs and before those larger tariffs get implemented, if they do. Elsewhere, we do see consumers kind of shifting away from discretionary types of purchases, especially things like travel. And they are doubling down on more necessary services and also goods. So you're going to continue to see growth, but how strong will it be? And what type of growth is it? Is it growth generated from buying things you need only? Or will we also see necessities, discretionary items also being consumed?
Dana, I don't know if anyone warned you, but if you mention cars, I will just lock onto that and never let go. So I think it's fascinating that we're seeing 15% across the board tariffs applied to EU, Japanese, and South Korean manufactured cars, while Ford, for example, when it builds cars in the U.S., has to pay 50% on the steel, 50% on the copper, 25% on components, 80% for Chinese magnets with stacked tariffs, and the list goes on and on. So what ends up happening, according to the CEO, Jim Farley, over at the Ford Motor Company, is that they have a $5,000 to $10,000 disadvantage versus, say, the head-to-head Japanese manufactured Toyota or South Korean manufactured Hyundai or GM vehicle. Does the consumer, you think, notice that, or just stay away from the foreign cars after tariffs go into effect for fear that they will be a higher price?
Well, it's tough to say. Like, every consumer likes a different type of car. And it also depends on what your family needs. But I think that certainly the big surge, it was something like almost 10% in auto sales from foreign auto sales, indicates that, yes, there still is fear that tariffs may rise and that they better get those luxury foreign cars now before we see tariffs or even export controls on things like computer chips or rare earths that go into cars.
All right, Dana, great to get some time with you. That is Dana Peterson. She is chief economist over at the Conference Board.
You know what? I have a foreign car, but what I need is a Chevy Suburban.
You need one.
Because the family just continues to grow, but they're so expensive.
I know, that's a problem, and we're going to talk about it at length. But coming up next, what investors need to watch over the next 24 hours. This is Bloomberg.
Let's look ahead to what else you need to watch over the next 24 hours. At 8:30 a.m., U.S. retail sales come out. We've been talking about that. At 10 o'clock, University of Michigan sentiment. And tomorrow, President Trump has a little meeting with Russian President Vladimir Putin in Alaska. You can catch extended coverage right here on Bloomberg.
But that does it for Bloomberg The Close. Balance of Power is up next. Have a great evening. This is Bloomberg.